Hello, and welcome to Arnerich Massena's first quarter 2019 MarketCast. After ending 2018 on a down note, markets roared back during the first quarter, closing near record highs. And while the market's volatility has settled down here, we expect volatility to continue as our nation confronts its unresolved trade, political, and economic policy issues. Senior analyst Arthur Coyne and investment advisor Kate Deines are here today to recap the quarter and look at how we're currently positioning client portfolios. Thank you for joining us today.
The U.S. S&P 500 just had its best quarter in 10 years. This came after the Federal Reserve effectively put its rate hike program on hold in January by leaving the Fed funds rate unchanged and stating that it would be patient in making future rate adjustments. The Fed's shift in policy also helped other risk-sensitive assets such as high-yield bonds and non-U.S. stocks. And even investment-grade bonds had a good quarter as the Fed's language signaled moderate expectations for economic growth and inflation. Now, 10 years after the stock market bottom of the global financial crisis, it's interesting to see how dramatically the crisis has affected returns over time. Here, the blue bars show the decade leading up to the low point of the financial crisis. During that painful lost decade, U.S. stocks declined an average of 3% annually or 26% cumulatively. Then, coming out of the crisis, the green bars show the most recent 10 years of returns. What a huge difference between the two decades. After losing 3% a year going into the crisis, U.S. stocks gained almost 16% a year or 338% cumulatively during the decade after the crisis. What this chart shows is how unpredictable investment results can be even over decades and how important it is to stay diversified. Looking to the future, what we're seeing now is that with the Federal Reserve likely to keep Fed funds rate steady for a while, investors have been lowering their expectations for where the Fed funds rate will be at the end of 2019 and 2020. In fact, by the end of March, the market was expecting the Fed funds rate to be drifting lower instead of higher over the next 2 years. This means that investors are now thinking that a period of slower growth could be on its way. And the Treasury yield curve is telling a similar story. Here we see that at the end of the first quarter, the 1-month Treasury yield was slightly higher than the 3-year yield. This inversion is a bit unusual because it means that investors have actually become willing to accept lower interest on their longer-term investment commitments. This implies that investors are collectively expecting that short-term interest rates are heading slightly lower, an outlook that's consistent with slowing economic growth. So, is growth in the world economy also slowing down? Global trade volume seems to be confirming this idea. Here we can see that growth in global trade has gone nearly flat due to U.S.-China trade tensions and reduced worldwide monetary stimulus. This, along with other indicators, has led economists to trim their worldwide economic growth forecasts. Now, for investors in risk-sensitive assets, even a mild slowdown could be challenging. Consider, for example, corporate bonds rated BBB. This is the lowest investment grade rating before high yield. These bonds now make up half of the entire U.S. investment grade corporate market, a much higher proportion than we've seen in the past. And as this chart shows, in recent years, the leverage or debt burden of the issuers has been rising. This could heighten price risk to the bonds if a decelerating economy leads to negative ratings changes. To put our positioning in a portfolio context, I'd like to now introduce investment advisor Kate Deines.
Thanks, Arthur. In this current market environment, we're actually seeing a lot of strong investment opportunities. First, we're taking advantage of this equity market rebound as an opportunity to rebalance client portfolios while managing risk. And within equities, we continue to remain overweight to both international and value stock spaces. In this bond market environment, we favor lower duration bonds while limiting exposure to lower quality credit. Where we do invest in credit, we favor active managers who we believe can best assess these types of opportunities. As always, your investment advisor will keep you informed about specific opportunities as they become available. For more information, please visit us on the web at arnerichmassena.com. Also, be sure to check out our recent white paper, Women in Investing, and our Impact Investing podcast series. Thank you so much for joining us today.